Stock markets are sitting at the top end of the recent trading range. It comes at a time where there is increased optimism around the potential for a deal to resolve the European crisis. We have heard that the Slovakian government finally approved the EFSF facility. This makes the sort of final European country to provide its vote there. There was a wobble earlier this week, as we know, with this particular vote, that they may vote against it. And certainly there are some sympathies as to why they should vote against it. A country that is poor, certainly its pension scheme pays out a quarter of that is provided to Greece workers. Their balance sheet has been finally put into good order, and all of a sudden they are plunged into a situation where they have to put up the number being somewhere between 7 and 10 billion euros to resolve the issues of a richer partner here in the shape of Greece. So one can certainly understand why there was debate here, but having got that particular bit over the line, it's another hurdle that is being crossed, which I suspect we're going to face more over the course of the next couple of weeks, but another hurdle that's being crossed towards some sort of financial resolution to the very short-term issues that Europe faces in resolving some of the funding requirements. So let's take a look at some of the charts that we're showing. As usual, we will start with the FTSE 100 just to sort of brief ourselves as to where the current trading range of the market remains, and we can see here that this 5,000 to 5,400 seems to be set in stone as the upper and lower levels of the market at the moment. Some optimism here that we are beginning to shape up above that level, albeit that I don't think it's going to get through in the very near future. As I say, in this current run, it is a level that is bringing in some profit taking, but nevertheless over the course of the next couple of weeks, this market is going to remain in volatile conditions, sentiment swaying to and fro, but I think mainly positive towards a build-up to some sort of resolution to be presented at the next G20 meeting. So as I say, that remains the key determinant of this market. And I think this optimism around Europe is reflected also in the currency market, a much deeper, more liquid market than equities, and so when we do start to get some big swings of capital moving around the globe, it typically comes through in the currency market. This move here that we saw on the downward stretch is reflecting of European weakness and dollar strength, and this was what we refer to as a safe haven trade. It was money returning to the currency of the dollar, but this rally here is more indicative of positive sentiment coming out of the euro at the moment, which has led to this sort of reasonably sharp rebound in the euro versus the dollar market. It's reflected of what we call a risk-on trade. It means that money is coming out of those deep safe haven trades of US Treasury and US currency, and it's starting to permeate back through buying more euro, and also coming back into the equity market and leading to those sort of top end of the range numbers. Now, we have spoken at length over the course of the last few weeks in relation to the fact that corporate earnings is at the moment, okay, it's not the main picture, but corporate earnings is going to be a steer for this market at some point. And I think this is going to be the message that will come through more and more over the next couple of weeks. We start off this week with the third quarter numbers in America, and as always we have Alcoa as the first US company to report its third quarter numbers. Now, these numbers missed expectations at the earnings per share level. Certainly the revenue guidance was slightly better than expected, so the numbers themselves, whilst the headline will read that they slightly disappointed, they weren't that bad in all honesty, and you can see that from the share price of Alcoa. It has been drifting along with the market. There was a temporary spike down below the $10 level, but that's been soon corrected in aftermarket trade. So I think that's, to be candid, quite a good sign that whilst the number of the headline may have slightly disappointed, the share price hasn't been hurt too badly. And if we take a look at some of the other companies reporting or due to report, J.P. Morgan is the first of the investment banks to have reported. Again, headline numbers there appear to be slightly better than expected. And again, if we take a look at that share price, as all investment banks have been under some pressure on their share price, that little tick up there more indicative at the moment of a sort of pleasing reaction in terms of the share price. So J.P. Morgan there. I'm going to sort of highlight one other company that reports next week. Next week will be much busier for US corporate earnings, so we keep an eye on these things because you do get guides. You do certainly find that US reporting earnings in certain industries, they do come through and to impact on some UK share prices. This is Apple. We've clearly seen some decline in Apple. There was two things that impacted on it slightly to the downside. The first being that the launch of the new Apple iPhone was seen as slightly disappointing originally. I think investors were looking for the iPhone 5 and what they got was the iPhone 4S. And there was some initial disappointment there. What I will pick up on is that the volumes volumes of demand for the iPhone S are apparently bigger than the iPhone 4, and that is, I think, an encouraging signal for both Apple, certainly for some of the suppliers into the Apple network, and really for the semiconductor and technology sector wide. That there is still very good demand for technology products, consumer technology products at this end, and you can see there that we obviously had the sad demise of Steve Jobs in the middle of that, but the share price is now heading back above that $400 level and approaching corporate results for next week. So I think there's some eager anticipation for those particular numbers. As always, just to highlight slightly or keep a balance to the whole thing, we are in the UK here seeing a few more profit warnings. There's nothing that I at the moment can say there's a particular trend. The warnings seem to be coming from specific businesses. Last week, you may recall, we had profit warnings from Mothercare. That was down to consumer demand. We had profit warning from Supergroup, but that was down to a distribution centre problem. Today we've got Renishaw, which is a very much one of our high-class engineering companies, and this business has performed extremely well from the recovery of recession. It's benefited from the low value of sterling. It's exporting its products worldwide. It's been doing very well. So why is it warned on profits? Well, interestingly, the European demand's holding up, the US demand is holding up. It's in the Far East that this company is actually finding that life's becoming a little bit more difficult. That really goes against the trend of everything we've been talking about over the course of the last few weeks about sort of sluggish Western demand and faster Asian demand. And so I'm just going to pick up on Renishaw. The share price has come back from £19 back in July of this year, back to really £8, £8.50 at the moment. Has it found a bottom? Don't know. We've really got to find out over the next few weeks how this sort of current soft patch in their demand transpires. On the face of it, it does look a very cheap situation. But I'm more interested in the fact that it is Far Eastern demand that is driving that particular profit warning.